One of the biggest lies banks tell us is that our money grows in our bank accounts. While it might seem like our money is increasing because of interest, the truth is that it doesn't grow in value due to inflation. When inflation is high and bank interest rates are low, keeping cash in the bank can actually reduce your wealth. In this video, we'll share 6 assets that can help you stop this wealth erosion and build intergenerational wealth. 1. Precious metals, gold, silver, and platinum. Money is valuable because it can store value for the future. However, governments print more and more money, which can lead to its devaluation. This is why financial experts recommend investing in precious metals like gold, silver, and platinum, which are scarce and can't be easily produced. Precious metals have historically increased in value during inflation. For example, before the 1950s, an ounce of gold was $400, and now it's over $2,000. According to PrimeXBT, gold's price could reach $10,000 by 2032. Investing in precious metals can protect your wealth from inflation. If you don't want to buy physical gold, consider gold ETFs, which offer exposure to gold prices without the need to store physical gold. Gold ETFs are an affordable investment vehicle that tracks the price of gold. They can be bought and sold just like stocks, making them a convenient option for those looking to add gold to their portfolio without dealing with storage and insurance issues. Silver and platinum can also be purchased in ETF form, providing similar benefits. Precious metals aren't just a hedge against inflation. They are also a hedge against economic uncertainty. When economies face crises, precious metals tend to hold their value or even appreciate, providing a safe haven for your investments. 2. Industrial commodities, raw materials. Precious metals are valuable because they are scarce and have natural utility. Industrial commodities like silver, cobalt, nickel, and copper are essential for various industries, including electronics and electric vehicles. For example, cobalt prices have doubled in the past decade due to its demand in battery production. Investing in raw materials can boost your portfolio during high-demand phases. While buying and storing raw materials might not be feasible for everyone, you can invest in mining company stocks, mining-focused mutual funds, or derivatives like futures and options. Silver, for instance, is used in the production of electronics, solar panels, and medical equipment. Similarly, copper is essential for electrical wiring, plumbing, and the manufacturing of electronics. The rise of electric vehicles has also increased demand for these metals. Cobalt is crucial for battery production, particularly in electric vehicles. The demand for electric vehicles is expected to grow exponentially, which in turn drives up the demand for cobalt. Nickel, another important metal, is used in stainless steel production and batteries. By investing in the stocks of companies that mine these materials, you can benefit from their rising prices. Companies like Rio Tinto and BHP Billiton are major players in the mining industry and can provide indirect exposure to these valuable commodities. Mutual funds and ETFs that focus on industrial commodities can also be a good option for diversifying your investments in this sector. 3. Safe haven currencies. In a world of fiat currencies, geopolitical stability is crucial. This is why the rich often keep their money in Swiss banks. The Swiss franc is considered a safe haven currency because of Switzerland's strong economy and stable political environment. During crises like the Eurozone debt crisis and the global financial crisis, funds often move to Switzerland to avoid currency depreciation. Superior currencies like the Swiss franc, British pound, and Chinese yuan can be good stores of value. If you can't open a Swiss bank account, consider currency ETFs or forex brokers to gain currency exposure with minimal investment. The Swiss franc, in particular, has a reputation for stability. Switzerland's political neutrality, strong banking system, and sound economic policies make it a reliable currency during times of global instability. The British pound and Chinese yuan also offer stability, with the UK and China being significant players in the global economy. Currency ETFs are an easy way to gain exposure to these stable currencies. These ETFs track the performance of foreign currencies relative to the US dollar, allowing you to invest in them without dealing with foreign exchange markets directly. Forex brokers also offer platforms where you can trade currencies, providing another avenue for investing in safe haven currencies. 4. Government securities. Look closely at a dollar bill, and you'll see it's labeled as legal tender, meaning it's backed by the full faith and credit of the government. Investing in government securities, GSECs, is a safe way to store value because governments are the last to default. In the US, you can invest in treasury bills, notes, and bonds, which offer better returns than keeping cash in the bank and are backed by the US government. Small investors can buy treasury securities directly from the government through the Treasury Direct portal or from the secondary market. Treasury bills, T-bills, are short-term securities that mature in 1 year or less. They are sold at a discount and pay face value at maturity, making them a low-risk investment. Treasury notes, T-notes, have maturities ranging from 2 to 10 years and pay interest every 6 months. Treasury bonds, T-bonds, have the longest maturities, ranging from 10 to 30 years, and also pay semi-annual interest. These government securities provide a reliable income stream and are highly liquid, meaning they can be easily bought and sold in the market. They also offer a secure way to preserve your capital, as they are backed by the full faith and credit of the US government. 5. Value stocks and mutual funds. Treasury investments provide better returns than cash but lower returns than stocks. Stocks, especially value stocks, can offer higher returns. Value stocks belong to companies with strong fundamentals and stable demand, providing steady price appreciation and dividends. Researching individual value stocks can be time-consuming, so consider dividend-focused mutual funds like the Vanguard High Dividend Yield Index Fund Admiral shares, which offer stable dividends and are easier to manage for retail investors. Value stocks are shares of companies that appear to trade for less than their intrinsic or book value. They often have a stable business model, consistent earnings, and a history of paying dividends. Companies in sectors like utilities, consumer goods, and healthcare often fall into this category. Dividend-focused mutual funds and ETFs invest in a basket of value stocks that pay regular dividends. These funds provide diversification and reduce the risk associated with investing in individual stocks. The Vanguard High Dividend Yield Index Fund, for instance, invests in a broad range of high-yielding companies, offering both income and capital appreciation potential. 6. Real estate. Land is a non-depreciable asset because it's scarce and always in demand. Real estate, including residential homes, office spaces, and commercial properties, acts as an excellent inflation hedge. Housing prices have tripled since 1992, despite dips during economic crises. While owning a home is a common goal, consider gaining exposure to real estate earlier in life. You don't need a lot of money to invest in real estate. REITs, real estate investment trusts, allow you to invest in real estate with small amounts. For example, Ventas Incorporated, VTR, invests in healthcare real estate. Alternatively, you can invest in rental properties, where the rent covers expenses and mortgage payments while providing profits. REITs are companies that own, operate, or finance income-producing real estate across a range of property sectors. They provide a way for individual investors to earn a share of the income produced through commercial real estate ownership without actually having to buy, manage, or finance any properties themselves. REITs are required to pay out at least 90% of their taxable income to shareholders, making them an attractive investment for those seeking regular income. Owning rental properties can also be a profitable venture. By purchasing properties and renting them out, you can generate a steady stream of income while building equity in the property. Over time, as property values appreciate, your investment grows. Rental properties can provide tax advantages, such as deductions for mortgage interest, property taxes, and maintenance costs. That wraps up our video for today. If you found it helpful, please like and subscribe to our channel. Thanks for watching until the end, and we'll see you in the next video.